Hi guys online, can you hear me? Please confirm my audibility. Hmm? Next week. Today we are completing the mocks and then next week onwards just hmm? uh, MCQ. Thanks for confirming, Yamin. No. My focus is mock right now. Since your mock, it is understandable with the mock itself. So if there is an if you want, you can. Is it? There was some. I mean, ratio wise, there was no issue, but I think that there you scored well. That you scored well. One call that. Hi, Yamin. So, is this your first attempt that you are doing, or is this your reattempt? And Amani, have you booked the exam or not yet? The exam booking done? Pencils. Uh, just be specific. Just give us a moment. We are doing this. No problem, Amani. I think you can still watch the recording. You can still watch it on YouTube. Available on YouTube last week. You should be able to watch it. I gave you a 30-day planner. Please check that out. Very important planner. Yeah, no problem for the beginning. What we can do is usually it's the other keyboard. All good. Thank you very much. Yamin, have you booked your exams? I have actually given mock. Just want to evaluate how well you have been doing the mock, just to see where we stand here. I think I've not seen you on the classes. We all have the. Sorry for that disturbance. So I hope you all have got access to the mock that I shared, Yamin and Amani. Have you got the access to the mock? Hmm? Only two, yeah. Omar also is supposed to send. Shenuri and you. So Amani and Yamin. I like to. Okay. I'll see if I hope you all have the LMS access. So I'll upload it in the limits, and I want you all to share your answers across with me before the next TRG session. All right. Test reach. Practice platform, right? Yeah, it's premium. Yeah. Should be check with, then should not. So you will be getting access to the pre-mock of December. Yeah, so it's releasing, I think, on 14th, right? So you should be getting access there. Right. Hi, Abdullah. Abdullah, have you done your exam booking? Just want to get a confirmation that all of you who are here are, exam booked people. If so, we can have focused attention. Right. Okay. So until Abdullah responds, how many standards do we have? We discussed last week, yeah? 26 standards. What are they? By now, when a standard number is given, you all should be able to recall what the standard is, right? So Abdullah, I want you to do the mock as well. Please do, if you can direct message on Zoom your contact numbers with me, I'll get in touch with you all there. Please share your contact numbers through a direct message. Yamin, Amani, and Abdullah. I'll share the mock with you all, and I'll be in direct contact with you all until the exams, right? To your focused attention. Right, so standards that we have to be precise in is IAS 1, IAS 2. IAS 1 is the normal financial statements presentation. IAS 2 inventories. IAS 7 statement of cash flows. IAS 8 accounting policies. IAS 10 is events after the reporting period. Then IAS 12 is taxes. 16 is property, plant, equipment, and the list goes on. So these are the standards, 26 standards that you all need to be familiar with. All right. Okay, so be familiar with all these standards. Out of this, I did discuss in my 30-day planner what areas are highly important, what areas are not very important, and what areas need to be given attention to. Okay, and the Kaplan Power 50, we did 10 questions last class, right? So we have done up to 28. We're starting with 64, which is IES 2. So what I'm planning in this class is to make it more engaging and interactive session. Last week, what happened? I read the questions, I discussed it, right? There was no time given for you all to attempt the question. Okay, although I have given you all the dosage 60 MCQs per day, not sure how far you all have been following that, but I hope you all are following that. But anyway, what we'll be doing today is we'll be taking 15 minutes, right? 15 to 20 minutes to attempt 10 questions. So there are 50 questions, right? So 20 minutes, 10 questions. Then we discuss. Discussion would take around 10 minutes, right? So that's 30 minutes. Then further 10 questions, 30 minutes. 20 questions there, 30 minutes, another 10 questions, 30 questions, 30 minutes, another 10 questions. So we'll be, in that way, we'll be able to interactively complete the Power 50, which is touching upon all the main areas, main standards. So, or what we can do is 5 questions, 10 minutes discussion, 5 question discussion. Or I think 10 minutes would be okay, no? I mean 10 questions would be okay, no? Right? So 10 questions, we would have a proper breakdown. There are 50 questions. We are done with 10. So we have 40 more questions, 4 sessions of 20 minutes, right? So every 20 minutes we'll be discussing. Discussion should take around 10 minutes. Then we move on to the next 10 questions. Is that clear? Are you all with me? That is the proceedings that we are going to follow today. Okay? Right. So what I'll do is I'll share this PDF with you all. Right. Right. It was not visible. Is the screen clearly visible, guys? Can I confirm? Is this clearly visible, guys? Good afternoon, guys, on YouTube. I hope you all can see the screens clearly. Yeah, I think it's visible clearly. So far, there is no issue. Right, I mean, there I kept it a little smaller, so could be, right? But nevertheless, I did share the study planner with you all, and I hope you all were able to access that. Yeah, right. Yamin, Amani, Abdullah, I hope you all got access to study planner, right? Study plan. You all able to have a look at it. Okay, so if I give you all time to attempt these questions, what do I do with the YouTube students? There are students watching on YouTube, so we'll do with it there. We'll go ahead with the discussion itself. Up to 10 minutes so that they also don't miss out. Right, so what we'll do is we'll try to break it to 5 questions per discussion, right? 5 questions, 10 minutes for 5 questions. Why? 2 minutes per question. I want you all to finish 5 questions in 10 minutes. All right. So what I'll be doing is I'll be splitting the screen. Excel. So guys online, if you all can at least get access to the Kaplan, I hope you all have access to Kaplan 24-25 revision kits. It's not. Right. So guys on YouTube, please have Kaplan revision kit of 2024-25 with you all. So I mean that would be an easier way for you all to access the questions and then for us to discuss the questions as well. Okay. Right. So let's go with 5 questions every time. 10 minutes for every 5 questions. Right. Right. Understood, Amani. Let me share that. Abdul and Yamin, are you all there on the group? WhatsApp group? If I share the PDF there, will you all be able to get access to it? Right. Abdullah is in. Yamin, are you in? Should I share the PDF on WhatsApp group with you all? Yeah? Okay. So what we'll do is we'll start off the discussion. I mean, the first 10 questions, let's discuss. Then next, the rest of the questions, let's start the interactive discussion, right? I don't want the YouTube students to be left out. So YouTube students, until then, please make arrangements with the revision kit of FR 24-25. All right. Okay, so question number 64. Right, so this focuses on IAS 2. All right, IAS 2 inventories. Straightforward standard. Is that a difficult standard? Yeah, no, not a difficult standard, right? Now, what this question says is Neville has only 2 items of inventory on hand at its reporting date, right? So what are 2 items? Item 1, materials costing 24,000 bought for processing and assembly for a customer under a one-off order, which is expected to produce a high profit margin. Since buying this material, the cost price has fallen to 20,000. Right. What do you think is the inventory valuation there? Is it 24,000 or 20,000? Quickly tell me. Azmat, what do you think? Is it 24,000 or 20,000? IS2 says lower of cost or NRV, net realizable value. So here, 24,000 has been the cost, but the price has fallen 20,000. What is going to be the value here? 20,000? The rest of you, what do you all think? Is it 20,000? Is it 20,000? Right now, read it again. Materials costing 24,000 bought for processing and assembly for a customer under a one-off order which is expected to produce a high profit margin. One-off, onerous contract, IFRS 15, onerous contract with outcome as profit. What happens there? Right? So again, provisions, onerous contract, outcome with profit. Now here what it says is when you are buying an inventory, in IAS 2 it says when you're buying an inventory for a specific order, right? Meaning you are going to receive that funds, right? And it's a high profit margin, right? What they're saying is order is expected to produce a high profit margin, right? So meaning there's a profit margin that you are keeping. So in that case, inventory value dropping is not going to be relevant, right? Since there's a high profit margin, it's going to be 24,000 that you'll be using here, right? 24,000 is what you're going to use here. All right. Item 2, a machine constructed for another customer for a contracted price of 36,000. This has recently been completed at a cost of 33,600. 33,600. It has now been discovered that in order to meet certain health and safety regulations, modifications at an extra cost of 8,400 will be required. The customer has agreed to meet half of the extra cost. Now, what is the cost here? What's the cost here? Cost is 33,600. What's the net realizable value? Selling price minus cost to sell. Okay. What's the selling price here? Selling price is 36,000 minus half of 8,400. Why? Half will be recovered from the customer. So how much is that? How much is that? 36 minus 4,200? 30. 30. 31,800. Abdullah, you deduct from selling price, you deduct the cost to sell. 36,000 minus 4,200 is 31,800. Okay. 24,000 here, and here the lower of both is what? Now what is lower? NRV is 31,800. So what's lower? Because it is cost is 33,600. NRV is lower, right? 31,800. 24,000 plus 31,800. How much is that? 31,800 plus 24,000 is 55,800. Okay. Exactly. Please be very careful when you're reading the questions. All right. Is that clear, guys? Right. So I'll just erase it from here. So its next question is clearly visible. Right. Question number 68. Magna owned cattle recorded in the financial statements at 10,500 on 1st of January 20x4. At 31st December 20x4, the cattle have a fair value of 13,000. If Magna sold the cattle, commission of 2% would be payable. What is the correct accounting treatment for the cattle at 31st December 20x4? IAS 41, right? What was the cattle's price? What are the cost of the cattle? 10,500. What does the standard say? What's the measurement criteria? Fair value less point of sale cost or cost to sell, right? So what is going to be the cost to sell? Now fair value is 13,000. 2% would be payable. So 2% of what? 2% of 13,000. How much is that? 260 is the cost to sell. The fair value is 13,000 minus 260. How much is that? 12,740. What was the cost? 10,500. What's the gain? What's the gain? 2,240. Now tell me this 2,240. Anyway, there's one option here. Statement of profit or loss, statement of change in equity, revaluation surplus, statement of profit or loss. This you record in statement of profit or loss, not other comprehensive income. The answer is going to be revalue to 12,740 and gain of 2,240 to statement of profit or loss. Is that clear, guys? Is that clear? We'll be coming there. Once we come to financial instruments, we'll take the question. Just note down the questions and keep. All right. Right. Now, next question. Question number 72. An entity took out a bank loan for 12 million dinars on 1st of January 20x1. It repaid 3 million dinars to the bank on 30th November 20x1. The entity has a reporting date of 31st December 20x1 and a functional currency of dollars. Exchange rates are as follows. Bank loan. Is it a monetary or non? What's the standard first? IAS? IAS? Azmat? What's the standard? IAS? 21. Exchange rate. That's the standard we're dealing with, right? Now, Azmat, you need to be very clear about the standards, okay? That's how you'll be able to recall the standard requirements. All right. Okay. So entity takes a bank loan. What does IAS 21 say? First, you need to understand whether it is a monetary or non-monetary item. Monetary or non-monetary. Bank loan, is it monetary or non-monetary? Monetary item. Monetary. Right. $12 million were till 12 million dinars was taken and repaid 3 million dinars. Right. So 12 million dinars. What's the rate that you take? The historical rate or spot rate? 12 million on 1st of January. So what was the exchange rate at 1st of January? 6, right? So 12 million divided by 6. How much is that? $2 million. Okay, right. The 3 million dinars were paid back on 30th November. So when settlement happens, the spot rate or the historical cost as settlement date. Right? So settled or unsettled transactions. Again, it boils down there. So monetary item, settled transactions on spot rate. Monetary item, unsettled transactions at the closing rate. A non-monetary item, unsettled at the historical rate. You also be able to recall what the standard requirement says. Okay? Right. The 3 million dinars at what rate? $5. How much is that? How much is that? $600. Right. Now it's a non-monetary item. No, non-monetary item needs to be revalued at the closing rate. Monetary item needs to be revalued at the closing rate. How much was balance? 12 million minus 3 million. How much was balance? 9 million was balance, right? Now tell me, 9 million divided by what was the closing rate? 5.6. So what was the outstanding dollar? Outstanding dollar? $1,607. This was what was outstanding. Now tell me what's the difference? 2 million minus 600. How much is that? 1.4 million becomes 1,607. What's the difference? 207. Is that a loss or a gain? Is that a loss or a gain? Loss. Why? It's a liability and liability has increased. It should have been 1,400, but it ended up being 1,607. But at the initial rate, how much was the loan taken? 12 million dinars were taken, right? 3 million dinars were paid. If we do it at the actual valuation, we see that there's a huge difference there. right? The spot rate, you see the difference. So that difference is impacting the organization unfavorably. Therefore, that is a loss of 207,000. Is that clear? Is that clear? 200 and also because they have already given in the question what is the total loss. That's also an indication that it's a loss, right? The questions are quite easy. They're supposed to keep those hidden, no? They give all the reveal all those. What's the use of thinking too much? Is it right? Question number 76. Ling enter into a contract to construct an asset. Okay, what's the standard? What's the standard? A contract to construct an asset. What's the standard? IFRS 15 revenue. Revenue from contract to customers. On 1st of January 2024, which is expected to last 24 months. The agreed price for the contract is $5 million. At 30th September 2024, the cost incurred on the contract were 1.6 million and the estimated remaining cost to complete were 2.4 million. On 20th September 2024, Ling received a payment from the customer of 1.8 million, which was equal to the full amount billed. Ling calculates contract progress using the input method. What is input method? Cost incurred. That's the input method, right? So based on input method, you need to identify what is the actual cost that has been incurred out of the total cost to incur, right? Now tell me what is the total cost here. First, you need to understand what's the total cost here. Agreed price 5 million. 30th September, the cost incurred on the contract were 1.6 million. Estimated remaining cost to complete to 2.4 million. So what's the total cost there? 2.4 plus 1.6. How much is that? How much is that? How much is the total cost? 4, right? 4 million. Now here, the progress is going to be based on the input method. Input method meaning cost incurred divided by total cost. That will give you the percentage of completion, right? Because that has been the cost increase. The output method, you have to see how much have been billed, right? The cost incurred, how much has the cost been incurred? 1.6 million. This is the cost incurred. 1.6 out of 4. How much percentage is that? How much percentage is that? 40%. Right. Now, 40% is what you are translating as your revenue. What's the total revenue? Total price is agreed price is 5 million, correct? 5 million. How much percentage is complete? 40%. The 40% revenue you have already earned that revenue, meaning you are supposed to receive that. That's 2 million. But how much has been billed? 1.8 million. Therefore, 200 is a contract asset. Again, they made it easy by giving it as contract asset. And they may have wanted to make it a little complicated, they could have not left it empty. So you had to figure out whether it's a contract asset or contract liability. Is that clear, guys? Is that clear? Right. It was all right. I mean, pre-mock is what is going to be decisive of the pre-mock of December. When they release that on 14th, that is going to be decisive of the level. That should be tricky, a little bit tricky. That's the value of doing FR. No, otherwise, what's the use of doing ACCA if everything comes in easy, right? So what's the use of putting so much efforts if everything is going to be easy? So it is supposed to be a little bit tricky, which I expect it to be as well. But what I expect from y'all is to be prepared, be thorough with all the areas. There are not many areas, only 26 standards, right? That's only 26 standards. Why? Because there are much more standards in practical life, and SBR is going to have more standards than this, right? And what you need to be particular about is the nitty-gritties of calculation. Now here input method, output method, how that works, what are the definitions, how you calculate the percentage, right? So input meaning cost, output meaning revenue. So based on that, now you need to have those nitty-gritties clarified, right? If you are clear with the entire area, I mean, you'll have enough preparation time. If you follow the 30-day plan also alongside your extra studies, I'm sure getting 70 plus is not going to be difficult. Okay, that's something that I can assure you all. All right. Okay. Then the next question says, Lock sells machines and also offers installation and technical support services. The individual selling price of each product are shown below. Sale price of goods 75, installation 30, 1 year service 45. That is the tricky part. But is that actually tricky? Okay. 1 year of service meaning you have to time a portion, right, over time. These 2 point in time. I hope you all know the 5-step model, right? Lux sold a machine on 1st of May 20x1, 1st of May 20x1, charging a reduced price of 100, including installation and 1 year service. Lock only offers discounts when customers purchase a package of products together, right? That's when the discount is given. All right. Okay. Now tell me, how are you going to allocate the cost? What's the total cost here? 75 plus 45 plus 30. How much is that? 150 the total. What's the actual price? 100 is the actual price out of 150, right? Okay. Now what you are supposed, you're going to use this fraction to allocate the $100 for each of these, right? So first item 75 into 100 over 150. Then there is 30 into 100 over 150. 45 into 100 over 150. Tell me. First one 50. Second one 20. Third one 30. Okay, when did this happen? It happened on 1st of May. When is the year end? Year end is 31st December. May, June, July, August, September, October, November, December. How many months is that? 8 months, right? So 750 and 20, you are directly taking that. 70, you recall. Now 30, you are going to divide by 12, multiply by 8. How much is that? How much is that? These are at a point in time. So you are recording 70. 30, you are going to record only for 8 months basis because it's a 1 year. So still there are 4 months to go. That is 20. What's the answer? 90. Okay. Which 10? There's no. Either the 10 that remain, that goes as not contract liability, that goes as if income has been received, it goes as a deferred income, meaning income the income that would be earned in the future date. That's a liability. Yeah, it's a liability, right? So you call it deferred income. No, nothing as such. It's just income that is not yet earned, right? It may have been received but not yet earned. Therefore, 10 million, you are going to show it under your liability if the cash has been received. That goes as contract liability. Show it as separate line item. Okay. Right. Is that clear, guys? Is that clear? Guys online, guys on YouTube, any questions so far? All good. Right. There's one more IFRS 15. Oh, not one more, I think 2 more questions. Why there are so many questions? Because this is a highly important area. Okay. Right. BL entered into a contract with a customer on 1st of November 20x4. The contract was scheduled to run for 2 years and has a sales value of $40 million. BL will satisfy the performance obligations over time. At 31st October, the following details were obtained. cost incurred, estimated cost to completion, progress at 31st December. They've given it clearly 45%. Applying IFRS 15 revenue from contract, how much revenue and cost of sales should be recognized? Now, revenue is going to be how much? Now, what's the total sales value? 40 million. 40 million, what's the revenue you're going to record? Why 18 million? 45% of 40 million, right? So revenue, you're going to take 45%. How much is that? 18 million. So we have 18 million option. So we are eliminating these two. These two eliminated, right? That's the elimination method you'll use, right? Then comes the cost. What's going to be the cost incurred? I mean, what's going to be the cost you're going to show? Cost incurred to date. They've given a very easy option. They've already given 16 million. The elimination method. Okay, now I can give you a trick, right? If you all want to do educated guesses, right, in your exam, if you feel stuck, yeah, if you feel stuck somewhere, there is a chance to make educated guesses. Now, educated guesses should not be stupid guesses. It should be thoughtful guesses. Now, for example, if you look at this question, now you can see revenue. Yes, they have been tricky. There are 240 millions given. There are 218 millions given. But if you go to cost of sales, there are 216 millions given. But 34 and 15.3 is repeated once. So whatever is repeated more number of times would ideally can be an answer, an educated guess. Now, without even doing all these questions, can we get that answer? 16 million is repeated, so we know 16 million. Now, 40 million, 8 million, what is that? 18 million and 16 million is matching, so that would be my educated guess. Okay. What's the actual answer? Actual answer is also that cost of sales requires you to record the cost incurred to date, right? You cannot be recording the estimated cost to completion. As cost of sales, only the costs that have been incurred will be recorded. Okay. And revenue, only revenue that is earned will be recorded. Proportioning, right? We don't cost of sales, we take cost entirely, right? Why I call this to be, because they have given a very easy way of educated guess. Even if you don't want to do the question, you can still make the educated guess and you can get through, right? That's the power of educated understanding, meaning knowledge, meaning preparation. Okay, when you all prepare, you all know that you all be able to make educated guesses. All right. Okay, so the answer is C. Right, then comes the final question under IFRS 15. Do you feel it as easier question? Easy? Then you have to be prepared for tougher question, right? Okay, Malik is a if you have not studied anything, all of these are going to be tough for you. Yeah, if you've studied everything, if you're not finding it tough, meaning you are in a good position. Yeah, that's what I'm saying. So if you're in a position, if you're in a good position, if you've prepared well, meaning you won't find it difficult. If you're finding it difficult, meaning you are not prepared well. Okay, for live class, I'm not sure. Yeah. Initially, right? Or was it for the mock? I don't think. I remember I told deferred tax, financial liability, that I was very clear that you need to work on. And there was one more area that I gave. If I have given meaning, there is something wrong in your mock, which is why I would have given you all that. IFRS 5, so that's not 50. Then now we need to be clear with the standard numbers, right? You confuse the numbers. IFRS 5, you need to work on it, right? Right. 80. So, guys, you all share your mocks with me as well. I will give you all a very tailored feedback on your mock, so that would help you all focus on areas that you all feel unprepared in, which is why send me your mock answers as soon as possible, so that will give you all enough time to prepare. All right. Right. Malik is a construction business recognizing progress based on work certified as a proportion of total contract value, output method. Malik will satisfy the performance obligations over time. The following information relates to one of its long-term contracts as the 31st May 20x4. Malik's year end is 31st of May 20x4, right? Contract price 200,000, cost incurred to date 135,000, estimate cost to complete 15,000, invoice to customer 120,000, work certified to date 180,000. Right. So what they are saying, how are they going to measure the progress? Work certified as a proportion of total contract value. So what is going to be the work certified as a total contract value? Profit is what you're going to look at, right? Okay. Now let's look at the revenue. What's the revenue you'll be recording? Work certified. How much work certified? The number is given clearly. 180,000. So you can use that figure itself. What has been the total cost of sales? Cost of sales meaning cost to date. How much? 135,000. These are contract assets, contract liabilities. You all need to focus on this area if you all find it difficult. Profit earned 45,000. But there is something to look for. In the year 31st May 2023, Malik had recognized revenue of 60,000 and a profit of 15,000 in respect of this contract. Total profit earned is 45,000. Out of this, you have to eliminate the profit of last year. Last year, you got 15,000. This year, 30. The answer is going to be 30,000. Is that clear, guys? Is that clear? Right. IFRS 15. How many of find the IFRS 15 challenging? The only challenging area, if at all, would be the contract assets, contract liabilities, and those special cases like sale and lease back and all the other special cases, which would not require a lot of focus, but have a complete understanding of IFRS 15 because this is the favorite area of the examiner. Right. Now we are moving into IFRS 16, another important area. During the year ended 30th September 2009, Hyper entered into 2 lease transactions. Right. What's the question? What amount in total would be charged to Hyper statement of profit or loss for the year ended 30th September 2009? Okay, when they talk about that, I told you in the last class specifically, what do you all need to recall when they say charge to Hyper statement of profit or loss? And when you look at lease transactions, what should come to your head? What should come to your head? Profit or loss, statement of profit or loss. About leases, what should come to your head? Finance cost, yes. And I told, this is something that I clearly mentioned in last week's IFRS 16. Very good, Yamin. Depreciation, right? Why? Because there are split. Always there is an initial, there's going to be a lease liability while there's going to be ROU asset as well. Both of these are going to impact statement of profit or loss. Sometimes in MCQs, you will be given only this option. Depreciation option also will be there. Lease liability option will also be there. If you do not add those two, you are going to go wrong. Right? Statement of profit or loss requires expenses. So finance cost related to lease liability would be one expense. Depreciation for ROU asset would be the other expense. You have to combine both. Clear? Right. There are 2 lease transactions. Let's look at what's the second one. On 1st of October 2008, Hyper made a payment of 90,000, being the first of 5 equal annual payments under lease for an item of plant. The lease has an implicit rate of 10%, and the present value of the total lease payments on 1st of October 2008 was 340,000. Right. What will be your asset value? Your ROU asset is going to be the present value of total lease payments. 340,000 is your ROU asset, right? While that is also going to be your lease liability, right? But the installments, the payments, right? So what happens? The payments are made in advance, right? Yeah, the payments are made in advance here. The payments are made in advance. You always deduct the payment made, then you calculate the interest. Remember, IFRS 16, payment in arrears, payment in advance. That's something you all need to be very clear about. When it comes to payment made in advance, you have to deduct the payment made in advance from lease liability. Then you multiply that by the percentage to arrive at the finance cost. What is going to be finance cost? 340,000 minus 90 payment has been done. The first payment has been done. 90,000 equal payments are happening every year. 340 minus 90, how much is that? 250. What's the interest rate? 10%. 250 to 10% is 25,000. Right? How did we arrive at that? 340 minus 90 into 10%. Right? That gives you 25,000. What is the ROU asset? What's the useful life here? Okay, when it comes to depreciation, let's quickly recall how are you going to figure out what's the useful life that you're going to consider. It's going to be based upon the ownership, whether you are going to own the asset at the year end, at the end of the lease period, or you are going to whether you are not going to own it. If you're going to own it, it's going to be the useful life of the asset. If you're not going to own it, the shorter of the lease period and the useful life of the asset is what you are going to use to depreciate the ROU asset. Now, what is the number of years? 5. Have they mentioned about the useful life or anything as such? There is nothing mentioned, so you are going to consider that 5 years as the lease period or the depreciation period. So that's going to be 340 divided by 5. How much is that? 68 plus 68. Now that's going to be your first type of expense based on first lease transaction, right? On 1st of January 2009, Hyper made a payment of 18,000 for a 1-year lease of an item of equipment, short-term lease. What do you consider it as? Exemptions of making the ROU lease liability requirement being fulfilled. Therefore, you can directly expense it. You can directly write it off as rental, right? As an expense. So that is going to be the other element of statement of profit or loss. So what's going to be total value? 25 plus 68 plus 18. What's the total? But are you taking 18,000 entirely? Are you taking 18,000 entirely? Always remember to look at the dates, right? Statement of profit or loss requires you to time a portion. So 1st of January 2009, when is the year end? 30th September. Now this is a 1-year lease term. Jan, Feb, March, April, May, June, July, August, September, 9 months. So you are going to take 18,000 into 9 divided by 12. How much is that? How much is that? 18,000 9 divided by 12. So guys, be very careful. The option might have the answer for full 18,000. It might have answer for 9 months. Everything that you do, may feel that you are right because you might see an option there. But you need to be very careful when you're reading the question. So what's the answer? 13,500 plus 68,000 plus 25,000. What's the total? 106,500. That's the answer. All right, that's the answer. Clear? Right. 88. Z entered into 5-year, again IFRS 16, 5-year lease agreement on 1st of November 20x2, paying 10,975 per annum, commencing on 31st October 20x3. The present value of the lease payment was 45,000 and the interest rate implicit in the lease was 7%. Is the payment in arrears or in advance? It's in arrears. Why? Because it's paid at the end of the year. So here what you have to do is you take the total lease payments as the brought forward value, which is 45,000. They're asking as the 31st of October 20x3. Yeah? Okay. Shall we use Excel for this? Or is this so okay? It's okay, right? So I'll just, yeah, since when I split the screen, it's not going to be visible. I got a comment today, therefore I'll be sticking to this, right? So I'll just go ahead and do the table on this itself, right? Right. So keyboard aside. Okay. Now what's the lease table here? Lease table always starts with brought forward value, right? Then there is going to be decision whether it's a payment in arrears or advance. This is a payment in arrears, therefore you will be taking the interest charge. You add the interest, then you have the payment Then you have the carried forward or year-end value, right? Opening or brought forward meaning opening balance, closing balance. You can use that as terms as well. Interest is going to be calculated at the opening value. If it was payment in advance, payment comes before interest, then the interest is calculated at opening balance minus the payment. Okay, that's the difference between advance and arrears. Right. What is the brought forward value here? Opening balance 45,000. What's the interest rate? 7%. 45,000 is 7%. How much is that? 3,150. Payment, how much was the payment done? 10,975. What's the closing balance? What's the closing balance? 37,175. Right. Then they are what they're asking non-current liability. Non-current on 31st October, you have to do the second year also. Right. So this is 31st October X3. Right. So non-current liability, is that going to be 37,175? No, right? It's always going to be the closing balance of the next year. So what is it going to be? 37,175 is the opening balance. What's 7% of 37,175? What's the 7%? Quickly tell me what's the 7%? 2602. Thanks, Yamin. Very good. Minus 10,975. What's the answer? What's the closing balance here? What's the closing balance? What's the closing balance? 28,802. Do we have that option here? Option B. Now remember, what is going to be your current liability in that case? If I may ask you, what's the current liability? Difference between 37,175 and 28,800. How much is that going to be? How much is that going to be? Quickly tell me. 8373, is it? 8373. Very good. But if you do in advance, now this is in arrears. In advance, how do you consider current liability? The payment is current liability, right? The payment is the current liability. The closing, the difference is going to be the non-current liability. That's the difference that you all need to focus on. Right. Next question. Is that clear, guys? Is that clear? Is that clear? Right. Am I too fast? Right. I hope the pace is all right. Yeah. Okay. On 1st of January 2023, Rabbit acquires a new machine with an estimated useful life of 6 years under the following agreement. An initial payment of 13,760 will be payable immediately. 5 further annual payments of 20,000 will be due commencing 1st of January 2023. Payment in advance or arrears? What is it? Advance or arrears? Payments commencing 1st January 2023. Advance. The interest rate implicit in the lease is 8%. The present value of the lease payments excluding the initial payment is 86,240. Excluding the initial payment. You need to exclude the initial payment to arrive at the opening balance. So what is going to be the initial payment? The opening balance. It's going to be, okay, I'll draw another table here. Brought forward, right? Then there is going to be, it's an advance, so therefore you will have the payments first. You deduct the payments first. Why? Because it is in advance. You're paying before hand itself, where only the interest is going to be based on what you have not paid, unpaid component, right? Then you will arrive at the subtotal, meaning the difference between brought forward balance and the payments, right? Then you will have the interest. Interest, what's the interest percentage? 8%, right? That's what the question told. 8%. 8% of your subtotal. Okay, then you will be arriving at your carried forward balance. All right, so what's the brought forward balance here? Opening balance is 86,240 excluding the initial payment. 86,240. What's the payment? 20,000. So what's the subtotal? 66,240. Tell me what's 8% of 66,240. Quickly tell me what's 8% of 66,240. 5299. Azmat is supposed to respond. What's the closing balance then? 6240 plus 5299 is going to be 71,539. Now that is going to be the opening balance, 71,539 minus 20,000 y payment in advance. Then what is going to be a subtotal? 51,539. What is the 8% of 51,539? Four, 1, 2, 3. So what is the carried forward balance here? 51,539 plus 4,123. How much is that? 55,662. Right. What's the question saying? What will be recalled Rabbit's financial statement on 31st December 20x4? 31st December in respect of finance cost, non-current liability, current liability. X3 is where it started, right? X3, X4. Now you need to do X5 also to arrive at at least half of that needs to be done. Right. How much is that? 55,662 minus 20,000 payment made in advance. That gives you 35,662. What is going to be the interest? 2853. Then you'll arrive at the closing figure, right? Now tell me what is going to be the finance cost at 31st December 20x4. Finance cost obviously is this y 20x4, right? 4123. Do we have 4123 option somewhere here? Yes, we have 4123 option, right? Only one option is there, meaning the entire is going to be the option. But let's see how. Current liability is going to be the payment due during the year. What's the payment due during the year? 20,000 is what is being made, right? As a payment, that's 20,000, right? So what is the non-current liability? 55 minus 20,000, meaning the subtotal of the X5, right? Why 20,000? At the end of 20x4, you are supposed to make 20,000 payment within the next year. So that becomes current liability. The difference between the opening and the current liability is going to be the non-current liability. Therefore, the answer is A. Is that clear, guys? Is that clear? Or is that difficult? Is that clear or is that difficult? Is that difficult, guys, or is it clear? Are we done? And questions we are done with. We are done with 20 questions in total. Now we are moving into 21st question. Let's go with the discussion itself, no? Or do you all want time to attempt these questions? You'd like to attempt, right? Okay. Right, so now this point onwards, I'll be giving you all attempting time. So I'll be sharing the we're completing it. 50. So we are done with 20, 30 more to go. 10 was done last week. So this is power 50. I've given 50 questions that covers the complicated areas, right? Very powerful questions that's going to help you. That's why I touched upon contract asset, contract liability, not the usual revenue, right? Here I've touched upon in advance, right? So all that I've touched upon to give you all clarity on all the areas. These are going to be powerful 50 questions, but still that doesn't mean you are not supposed to attempt the rest. You all are supposed to attempt the entire Kaplan kit. All right. Right. So now I need to, since Azmat also wants to attempt. Online guys, what do you all think? Do you all want time to attempt, or do you all you all want the discussion to proceed? Guys online, you all tell me whether you all want time to attempt or you all want the discussion to proceed. Because sometimes what happens, discussions also helps you all to remember things better. Right? Online guys, quickly tell me, Abdullah, Amani, Amin, what do you all want me to do? YouTube guys, you all can use live chat and let me know. You'll have access to the Kaplan revision kit of 25-26. If you'll have the revision kit of Kaplan access, then we can attempt. But still, y'all can use the live chat to let me know what to do. Amani, Yamin, Abdullah, what do y'all think? I hope I'm audible, guys. Discussion, right? So YouTube says discussion, online says discussion. So let's proceed with discussion. Okay. Right. So you anyway, I want you all to re-attempt it at home. So please attempt the entire kit. What we've done, I'm sure you all are going to forget. Right? I'm sure you all are going to forget what we've done today. Right? But at least go back and attempt Kaplan revision kit twice. All right. So we'll proceed with the discussion itself. Right. Right. Question 95. On 1st of October 2023, Fresco acquired an item of plant under a 5-year lease agreement. The agreement had an implicit interest rate of 10% and required annual rentals of $6 million to be paid on 30th September each year for 5 years. 30th September each year for 5 years. Arrears or advance, tell me. 30th September each year. 1st of October is where it starts. That is arrears. Okay, arrears. Right. If it's arrears, what happens? Opening balance, interest, payments, closing balance. That should be in your head. That table should be in your head. Okay. Fresco acquired an item of plant under a 5-year lease agreement. 5-year lease agreement. The agreement had an implicit interest rate of 10% and required annual rental of $6 million to be paid on 30th September each year. This is the payment every year. The present value of the annual rental payment was 23 million. Now that is going to be your opening figure. Right, brought forward plus interest at 10% minus payments, closing balance. All right, so brought forward 23 million. 10% of 23 million is how much? 2,300. What's the payments? 6 million. What's the carried forward balance? 23,000 plus 2,300 minus 6,000. How much is that? How much is that? 19,300. Right. So 19,300 becomes the opening balance of the next year. Interest of 19,300, 10%, 1,930 minus 6 million. What's the carried forward balance? 19,300 plus 1,930 minus 6,000. How much is that? How much? 15,230. What are they asking? The current lease liability. This is going to be non-current. So what's going to be the current difference between both the closing balances? How much is that? 4,070. Do we have that option here? All right. Question number 97. On 1st of January 20x4, Stark entered into sale and lease back of its property. When it was sold, the asset had a carrying amount of 6 million and a remaining life of 10 years. Stark sold the asset for 7 million and leased it back on a 10-year lease, paying 1 million on 31st December each year. The lease carried an implicit interest rate of 7%. What happens here? Sold and leased it back on a 10-year, paying 1 million on 31st December each year. Assets carrying amount was 6 million, remaining life of 10 years. Right. Okay, now tell me, will this be considered a sale or not? Quickly tell me. Is it considered a sale or not? If not sale, why? Why not sale? Yes. The stock sold at 7 million, right? Carrying amount was 6 million, right? And leased back, right? For 10-year lease, paying 1 million on 31st December each year, right? So paying 1 million each year. So Stark has retained the control, right? Remaining life of 10 years, right? 10-year lease, meaning Stark has retained control throughout the asset's useful life, right? So this will not be considered a sale because the asset is to be considered retained. The control is retained, right? Therefore, the 7 million, if it is not considered a sale, what do you consider it as? Loan. Exactly. We'll be considering it as loan, and the loan treatment is what you'll be giving. So now they are asking what is the total expense that should be recorded in the statement of profit or loss. What is going to be a total expense, guys? What includes total expense? One is going to be the loan interest, right? What else? Do you see anything else that goes under the expense, statement of profit or loss expense? Very good. Right. So tell me, what is the depreciation? It's going to be the carrying amount divided by 10. 600 is going to be a depreciation. What is your finance cost? 7 million into 7%. How much is that? How much is that? 490. So what's the total? Total expense? 600 plus 490 is 1090. Is that clear, guys? Is that clear? Sale and lease back. Now, when it comes to sale and lease back, there are some formulas. If you consider sale, then you have to follow certain formulas to figure out what's the profit, what's going to be the right of use asset, and lease liability. So focus on that. Sorry. Focus on the formulas. Right. Okay. With that, we are done with IFRS 16. Now we are moving into another interesting area that the examiner loves. What is it? Financial instruments. How many of you all still find it challenging? Financial instruments. You're okay? Okay. Right. You need to remember the theory mainly. Right. Yeah. Got it right. Okay. So guys online, do you all find this area challenging? Or this is an okay area? What do you all think? Right, so remember, financial instruments, again, financial assets, financial liabilities, what you need to mainly focus on is how the amortized cost table works, as well as compound financial instruments work, meaning convertible. Now this question is going to be based on a compound financial instrument. All right, the question says an entity issues 3,000 convertible bonds at the start of the year 1 at par. They have a 3-year term and a face value of 1,000 per bond. Interest is payable annually in arrears at 7% per annum. Each bond is convertible at any time up to maturity in 250 common shares. When the bonds are issued, the prevailing market interest rate for similar debt without conversion options is 9%. The relevant discount factors are shown below. Right. Now, what are you supposed to consider here? The compound instruments. The compound instruments always is split into equity and liability. Liability is going to be present value of future payments. So what are going to be the payments? Interest payments for every year, and you are going to have the par value, right? Par value payment at the end of the repayment. We call it repayment, right? Repayment, par value repayment, right? Repayment. So interest, what do you consider interest? The 7% or 9%? 7 or 9%? The 2% is given. 7%. Why payment? Right? How much you're paying every year? That's going to be 7%. Now, what's the total liability value? 3,000 into 1,000 per bond, right? So, what is the value? 3 million. Right? 3 million. Now, 3 million into 7%. How much is that? Per annum, what's going to be the interest? 3 million into 7%? 210,000, right? And at the year end, it's going to be 3 million plus 210,000. Why? It's going to be the repayment plus the interest at the end of the year. So what is the time period? It's 3 years, right? Right? Now, when you consider present value, what is the discounting factor you're using to consider present value? What's the discounting factor you'll be using? 9%. Why? Because that is the prevailing market interest rate, right? So now we have 3 years, right? 3 years, right? Year 1, year 2, year 3. 210,000, 210,000, 3 plus 210,000. Into, we have the factors given 0.914, 0.837, 0.7766, 0.914, 0.837, and 0.766. Quickly tell me the answers for each of this. Here it is 19. Now give me full value. 19191. Give it 10,000 into 0.914. Don't make it 210. 191940. Year 2. How much is that? 175770. Right? And final year. How much is that? 7. Okay, 770. That's okay. 766, yeah. 2458860. Now tell me the total value of this. 2458860 plus 175770 plus 191940. What's the total? 2826570. Thanks, Abdullah. 2826570. Right, that is going to be the present value, and this is what you are going to record as your liability. Okay, so what is going to be equity? What's the total bond value? Total bond is 3 million. So your equity is going to be the difference. Equity, how much is that? 3 million minus 2826570, 173430, right? Remember, the equity would remain that value every year, but liability would be changing by using the amortized cost table. This would be the opening value of your amortized cost table. Then the payments, you are going to take 7% and 9% you are going to take the interest, the amortized cost table. Debt element, how much is that? 2826570, equity 173430. Is that clear? Is compound instrument difficult? Yeah, now you can ask. Yeah, so it depends on the if you take debt element, it depends on the business model and the contractual cash flow, right? But if you take the equity element of your asset, that is dependent on the business model, whether it is used for trading or whether it is used for, now there is no necessity that you're going to get dividend always. No, if you're using for trading, what happens is short term, so gains you record through profit or loss. Now whatever can be realized, right, and realized quickly, that's what you need to understand. Whatever is realized then and there is shown through P&L. Why? That will need to be considered for a profit, right? And that would give a actual picture of what your profitability is. right? But if you are not using if you're not using it for trading, rather to hold to maturity the equity instrument, then that you're not going to earn, profit or loss, you know. Now, who told you dividend? If dividend is paid, the tax, I mean, you can just, what was your question again? That's contractual cash flow test and business model test, right? So contractual cash flow meaning the main earning. Now that's where, remember, that's where amortized cost table. I had clarified on this by bringing in how amortized cost table works, right? So when you take debt, right, that is where there is going to be contractual cash flow. Why? Because you are going to receive interest on that, right? And you will have to use amortized cost table wherever the interest factor is involved, right? Whatever you will be repaying at the end of the year, whichever does not give you the ownership, right? So always remember, financial assets, there is equity, there is debt. Now equity, to consider it as fair value through other comprehensive income, you need to make sure at the initial, when the recognition stage, you decide, okay, I'm not going to trade, I'm going to use it to keep it for maturity. So that is an irrevocable choice you've made at the initial stage itself. So at that point, you decide to go with fair value through other comprehensive income. But if you do not make that irrevocable choice, and if you still consider that no, I will be doing a short-term trade, then you will not be able to hold it through fair value through other comprehensive income, right? On the other hand, if you take the debt component, right, the when you financial assets or investment in debt, now there the contractual cash flow and the business model test both need to be satisfied. When the contractual cash flow test is satisfied, then you go with the business model test. Business model can either be to hold to maturity, it could be either to do a short term trade, or it could be in between where you don't know, you might use it for trade, you might use it for maturity. In that case, whatever you are holding for maturity, you'll use amortized cost, right? Whatever you are keeping until maturity, whatever you are trading, you do it through fair value, profit or loss. But whatever you're not sure about, now you're not sure now what you're going to do. So now, as I told you, OCI is an area that even IASB is a little confused as to why do we have an OCI component. But why they have brought OCI is to park any low value or low reliability based figures. Right now, there is no clear clarity, so you park it under fair value to other comprehensive income, because if you park it through FEPL, that will distort the profitability, right? And what is required for the decision users to make decisions? It is a fair value through, I mean, the profit or loss statement, right? OCI, not many consider that also, right? Those who want to, they consider that. Why? That is known as a low quality earnings, right? That is what goes under other comprehensive, but whatever is not realized. So when we are not sure whether you are going to hold it for maturity or whether you are going to trade, that you parking through fair value through other. Doesn't make sense, because dividends are always paid out of the profit after tax. Yes, so when you dividend received an interest, I mean income received, no, that you are paying tax. But when you're paying a dividend, you're not paying it out of taxable profit, no. That you are paying out of profit after tax. Only you take the profit after tax, then you do the dividend payment, and that is dealt with under statement of changes in equity. Okay, but whatever income you earn through dividend, that is taxed. Okay, right. But there is no tax purpose involved to understand whether it is. Practically, as I told you, practically this is a very complicated area. There are many situations, many different aspects, subjective judgments, but at FR level you're not supposed to think from that angle. FR level, you are supposed, if you start thinking through that level, you are going to screw up at your exam. Yeah, so after FR exam is done, you start thinking about that. That'll be helpful for SBR. Okay, is that clear? Right, question 101. Right now, here what the question says is, on 1st of July 2007, an entity purchased a 5-year loan note investment with a par value of $7 million. The investment was purchased at a 12% discount. The loan note has a coupon rate of 5%. Now, you all need to be clear of what coupon rate, what par value, what the interest or effective interest rate, all that you all need to be clear with, right? And effective interest rate of 8%. What is coupon rate? Coupon rate is going to be the rate you're going to use to understand the payments. And effective interest rate to understand the actual interest, right? What you're going to add and what you're going to deduct. Interest is receivable annually in arrears. The entity has the intention of holding the loan note to receive the contractual cash flows. Right. How much finance income should be reported in the statement of profit or loss of the entity? Now, this is what's the intention? Holding the loan note to receive the contractual cash flow. What happens? They decide to hold it until maturity. So, amortized cost. So, here it's going to be the interest income that you're going to show through your profit or loss. Okay. So, how much finance income you're going to record? What's going to be the opening? Now, there's a 12% discount, right? How much is that? 12% discount. How much is that? 7 million into 88%. 50. 7 million into. Now, tell me the 88%. The value. Yeah. Deduct 12% and 88%. 7 million to 88%. 7 million is a figure. How can 88% be above 7 million? You're making 6 there. 6160. 6160. Now remember, your interest is going to be, what's the interest percentage? 8%. 8% of this figure. How much is that? 8% of 6160, not 7 million. It's 6160. What's the figure there? 493. Payments is going to be payments. What's the percentage? 5% coupon rate. 5% into 7 million. Remember, not 6160, 7 million. 350. Now that is going to be the payment throughout. So what's the closing figure here? Is X8. Huh? What's the figure? 6160 plus 493 minus 350. What's the answer? 6303. Right. 6303 is going to be your opening figure for X9. Interest of 8% into 6303. How much is that? 6303 into 8%. How much is that? 504 minus 350. What's the closing balance? 6. What should be closing at? 6303 plus 504 minus 350. 6457. What's the question? How much finance income should be reported in the statement of profit or loss of the entity for the year ended 30th June 20X9? How much is that? 504,000. Okay. Right. You need a break, right? How many questions are done? Let me check how many questions. Sure. Started 13 questions. Let's complete a 106, right? Until 106, and then we'll take a break. Okay. Right. Next question, 102. ABC purchased 10,000 shares on 1st of September 20x4, making the election purchase 10,000 shares, investment in equity instrument. Election to use the alternative treatment under IFRS 9 financial instruments. What's the alternative treatment? What's the alternative treatment? What's the default treatment? FVPL. Or therefore, alternate treatment, FVOCA. There is no amortized cost there, right? Why? Because there is no interest factor. There is no contractual cash flow, right? The shares cost 350 each. Transaction costs associated with purchase were 500. Okay, transaction cost when held through FVPL, you have to expense it. When it is held through OCI, you are and amortized cost, you are supposed to capitalize it. So you are going to capitalize the 500. The 10,000 shares have been purchased for 3.50. 3.50 into 10,000, how much is that? 3.5 into 10,000 is 35,000. Now plus 500. So that, what's the cost? 35,500 is the cost. What happens now? Shares are trading at 4.50 each. 4.50 into 10,000 is 45,000. What's the difference? What's the gain? 9,500. Straightforward. Gain to be recognized is 9,500. Is that clear? Right. Remember, alternative treatment is going to be what is not default. That's OCI. Okay. 35,000 plus 500, which is 35,500. 45,000. Difference is 9,500. 9,500. Right. Next question. On 1st of January 2023, Bertrand issued 20 million convertible loan notes that carry a coupon rate of 6% per annum. The loan notes are redeemable on 31st December 2026 at par for cash or can be exchanged for equity shares. A similar loan note without the conversion option would have required Bertrand to pay an interest of 9%. Now, what is that interest rate? That is going to be the effective interest rate that you'll be considering for discounting factor. 6% is going to be the payment factor. What is, now this question we already did, liability, equity, right? So liability is going to be the present value, equity is going to be the balancing figure, right? Balancing figure. Right. $20 million convertible. $20 million. $20 million into 6%. Tell me what's going to be the interest that you're going to earn. What's the cash flow? 20 million into 6%. 2 million. 1 point. Right. 1,200 is going to be the annual cash flow. How many years is it? Redeem 31st December 2026. So that's 3 years, right? So year 1, year 2, year 3. Year 1 is going to be 1,200. Year 2 is going to be 1,200. Year 3 is going to be 1,200 plus the 20,000, right? So that's going to be 21,200. What's the discounting factor you're using? 9%. This into 0.92 into 0.84 into 0.77. What's the figure? 1104. 1104. 1008. And then how much? 324. What's the total? 16,324. What's the total? 16,324 plus 1,008 plus 1,104. 18,436. Right. So what is the balance? 20 minus 18,436. Now this is liability. Equity is going to be 1,564. That would give you 20. Yeah. What are they asking? How much would be recorded in equity? 1,5. Is that difficult, guys? No, right? Straightforward, yeah. Right. Wonder issued 20 million 5% loan notes on 1st of January 20x9, incurring issue costs of 600,000. The loan notes are redeemable at a premium, giving them an effective interest rate of 7%. What expense should be recorded in relation to the loan notes for the year ended 31st December? What are the expenses you'll be considering here? Issue cost of 600,000. So what do? Capitalize it, right? So in terms of liability, how the capitalization works? You add or deduct. Add or deduct. For asset you add, for liabilities you deduct, right? 20 million minus 600,000. How much is that? 19.4. That's the opening liability value, right? Now 19.4 into what's the interest rate? 7%. That's what you need to consider. How much is that? 19.4 into 7%. 13135. The answer. That's financial instruments. Was that difficult? We looked at financial assets, we looked at financial liabilities. Mainly we focused on the convertible instruments there, and here we looked at both the equity and the debt instruments. All right. As far as the concept is clear, although it's the most technical area, as far as the concept is clear, the questions are going to be manageable. All right. Okay. Now let's take. Now we are moving into IAS 12. Therefore, let's take a short break of 20 minutes and let's come back and, or 15 minutes, 20 minutes, whatever you're feeling about. So we need to complete 50 questions. Remember that. So let's come back in 15 to 20 minutes. Right. So it's 3:50 right now. Come back at 4:10. All right, guys. Shall we proceed? Guys, I'll be back online. I hope you're back. Guys online, please confirm. I'll back. Just a quick confirmation. All right. Okay. Thanks for confirming. Right. Question 110. Now here, what's the standard that we are going to look at? IAS 12. Very good. Taxation. Right. We are going to look at IAS 12, taxation. The question says Hudson has the following balances included on its trial balance at 30th September 20x4. Taxation 4,000 credit, deferred taxation 12,000 credit, right? The taxation balance relates to an over provision. When it's credit, meaning it's an over provision, right? So over provision, what you have to do? You have to deduct, right? When it's a debit in your statement of profit or loss, it is going to be an increment, meaning you have to add that. Since it's credit, you are going to deduct that. Deferred tax credit, meaning that is the opening balance, right? At 30th June 20x4, the director estimated the provision necessary for taxation on current year profits is 15,000. Now that's going to be the profit. The carrying amount of Hudson's non-current assets exceeds the tax written down value by 30,000. Difference of 30,000, tax rate 30%. What is going to be the deferred tax impact? 30,000 and 30% is how much? 9,000. Right? Okay, 9,000 is the closing balance. What was the opening balance? 12,000, right? What happened? The provision reduced by 3,000. That's going to be the change between opening and closing deferred tax provision. Right? Right. Now, when it comes to the tax expense, what elements are taken into consideration? The current tax provision, current year estimate. How much is that? 15,000. Then there is an over provision. Over provision, you have to deduct provision. Deduct. How much? You have to deduct 4,000. Change in deferred tax liability. Right? Is that a positive change or negative change? It's a negative change. By how much? 3,000. So what's going to be your tax expense? 15 minus 4 minus 3? 8,000. What's the answer? Okay. Right. The next question says, Holmes has the following balances included on its trial balance at 30th June 20x4. All right. Taxation 7,000 credit. Again, what is it? It's an over provision. Deferred taxation 16,000. That's the opening balance. The taxation balance relates to an over provision from 30th June 20x3. Okay. Then at 30th June 20x3, the director estimated the provision necessary for taxation on current year profits is 12,000. The balance on a deferred tax account needs to be increased to 23,000. What was it? 16,000. What does it need to become? 23,000. What's the change here? What's the change here? 7,000. That's the change, is it? That's the change. 23,000 minus 16,000. During the year, Holmes revalued its property for the first time, resulting in a gain of 10,000. The rate of tax is 30%. Right now, what happens here? A revaluation gain. What does it do? It increases. I mean, there is a temporary difference increase, right? So now this needs to be recorded in other comprehensive income. Okay. Now tell me, 10,000 and 30%, how much is that? 10,000 and 30%, how much is that? How much? 3,000. Right? This is going to be recognized as OCI. Right? In revaluation gain, tax you're going to deduct. So what is going to be the statement of profit or loss in impact? The current year estimate. How much is that? 12,000. Over provision. Over provision. How much? Minus 7,000. Changes in deferred tax. Now this is, they're asking statement of profit or loss. Statement of profit or loss. So you have to deduct. Now 23, 7 becomes 20, 16 becomes 23, 7 there, minus the 3,000, because this is going to be shown under OCI. Why? It's related to revaluation. Whatever is related to revaluation shown under OCI, not under P&L. Therefore, you are going to reduce 3,000 from 7,000. Right? 23 minus 16 equals 7. Minus 3. What's it? 4. Right? So deferred tax, what's the difference? Is it addition or deduction? It increases by 4,000. How much is that? 12, 16 minus 7 is 9,000. Do we have an option? Is that clear, guys? Is that clear? That's IAS 12. Very few. But in section C, always, right? Oh, did I tell you you have to look at IAS 33 as well? Yeah, mock. I did, right? Okay, that's all something that you have to, because you're weighted and now that this reminds me of your mock, right? Because we're moving into IAS 33. Some figure was wrong, which is why, no, even your weighted average number of shares also was wrong. Okay, if you want, we can just review your mock. But there was some issue that required table to be done, right? Possibly, right? All right, guys, is that clear? Quickly show me a thumbs up. Abdullah, Amani, Yamin, is it clear? Right, okay. Now we are moving into IAS 33. What's more challenging in IAS 33? When there is a convertible. Okay. The Coral Co. has net profit for the year ended 30th September 20x5 of 10.5 million. Coral has had 6 million shares in issue, right? 10.5 profit, 6 million issues for many years. On 1st of October 20x4, Coral issued a convertible bond. Okay, now comes the dilution. It had an initial liability element of 2.5 and the market interest rate for non-convertible instruments is 8%. The bond is convertible in 5 years with 50 shares issued for every 100 nominal of convertible bond held. Coral Co. pays tax at a rate of 28%. So when you convert this, what happens? Right now you are paying interest, right? When you convert, you are going to avoid that interest, right? That's a benefit you receive. But when you avoid that interest, that increases your income. When that increases the income, that is going to impact your taxation. So you have to deduct the tax value. That's when you will, that's how you'll be able to adjust the earnings based on the diluted earnings per share. Okay. So how are you going to adjust the earnings? What was the actual earnings? 10.5 million. Right. Now you have to assume that this is converted. When you convert, what happens? You are going to save on the interest. What's the interest? 2.5 into 8%. How much will be the interest saved? Quickly tell me. 2.5 into 8%. 200. 200,000. Right? Or if you want, you can do that taxation impact both, and then you can convert there as well. So let's do it in that way. Right? Let's keep 200 here for the moment. Right now, tell me what's going to be the tax rate they've given here. 28%, 228%. How much is that? Tax is going to be this into 28%. How much is that? 56. Right? So this is what you're moving here. 200 minus 56 is going to be 144. Right? 144,000. That's going to be the addition. And that would give you your diluted earnings as 10,644,000. Okay. When it's diluted earning, first you have to think as if the conversion has already happened, right? So when the conversion happens, you definitely are going to save on the liability. You're going to save the interest. So you have to deduct that interest, but you have to add that, you have to take net impact. When the interest goes down, the tax also has to increase. Why? When the profit increases, tax increases as well. Therefore, you take the net impact and you add that to your earnings, and that would give you your diluted earnings. Now that is what you are going to divide by diluted number of shares. Now diluted number of shares, how the conversion happens? 2.5 million. 100 nominal value, 50 shares. So 2,500 divided by 100 into 50. Tell me. 1 to 50. That's the number of shares that's going to be added. So currently, what's the share? 6 million. 6 million is the existing. You add 1250, that gives you 7250000. So now the earnings per share is going to be earnings over share. So how much is that? 10,6, or let's not just put that. We have that. Let's just divide this. 10,644,000 divided by 7250000. How much is that? How much is that? 7250000, or 10,644 divided by 7,250. Eliminate the triple zeros at the end. How much is that? 146 point always 8. Do we have that option here? Why did you do that? Didn't consider. Very good. Very good. That's a problem. You can't ignore anything in your FI level. Then you did not pay attention to IAS 33 lectures, is it? You forgot it, right? That's why I asked you to review. But I have actually given that in 30-day planner somewhere where IAS 33 needs to be covered. So please make sure you cover that. The dilution is important. When they ask you earnings per share, there is dilution as well. Yeah. Now you know how to do that. So now just keep that in mind. Whatever areas I've given you, just go and review the theories again. Okay. Right. Is that clear, guys? Diluted earnings per share. Always give it as decimal, Yamin. So it needs to be in cents. Decimals need to be there. 147 is when you round it off. So 146.8 when you take it in decimal, right? The cents. All right. Okay. Then comes another diluted earnings per share. Now here, what's the case? ISCO's financial statements show a profit for the year to 31st December 2025 of 2 million. On 1st January 2025, ISCO had 4 million shares in issue and made no further issues of shares during the year. At 31st December 2025, there were 1 million outstanding options to buy shares at $3 each for the year to 31st December 2025. The average market value of ISCO's shares was $5. Now, what is this? This diluted earning per share is going to consider the share option that is going to be convertible. Now, here there is going to be a free share component. Remember, right? Free share component. So what are they saying? 1 million outstanding options to buy share at $3 each. So what's going to be the extra amount that you're going to receive? 3 million, right? 3 into 1 million, 3 million, right? Right? But at the what's the market value? What's the market value here? 5 is the market value. At market value, how much will you be able to purchase at 3 million? Tell me. You pay $3 million, how much will you be able to purchase in terms of market value? Tell me. How many shares? Now here you are getting 1 million shares. But market value, how many shares? 600,000. So what's the free share? 600 you can buy, but you're receiving 1 million. So how much free share component do you have there? 400,000. So first you have to figure what the free share component is, and then you are going to take the earnings of 2 million. There is no earning change here when it comes to share options, and you divide by the in issue 4 million plus 4 million plus 400,000, right? So how much is that? 2 million divided by 4.4 million. Tell me, what's the earnings per share? What's the earnings per share? 45.5. Very good. Is that difficult? Share options? No. Remember, when it comes diluted in terms of convertible, you have to change your earnings. Why earnings is going to be diluted? Then you have to change your number of shares. That's going to be diluted when you convert it. But when you take a share option, earnings does not dilute, but it is going to be only the number of shares that's diluting. So you consider the free share component, you add that free share, and you arrive at your earnings per share. Clear? Right. Okay. Earnings. Now you have to tell me what is going to be the earnings that you'll be considering for earnings per share calculation. What's going to be the earning figure? Gromit by Gromit. Will you be considering the entire 2.8 million or not? Is in terms of group. Huh? We have not done that question in the past. They looked at situation as such in the past. So I brought it here. Right? So remember, when there is a group account and they ask you to calculate earning per share, you are not supposed to use the entire 2.8 million profit or the total comprehensive income. Rather, it is going to be the profit attributable to the parent only. This is the figure you will be using as your earnings, not 2.8 million. Okay? In normal single entity, you are going to use 2.8 million. But in this case, since it's a group account, NCA component is not yours, not your earnings. So you're not going to consider that. You're going to consider only the profit attributable to the parent. What's the amount? 225. Right. Now, IAS 33 is also important as well. I've given a couple of questions here as well. Right. Now, tell me, on 1st of October, Hoy had 2.5 million of equity shares of 50 cents each in issue. No new shares were issued during the year ended 30th September 2024, but on that day, there were outstanding share options to purchase 2 million equity shares at 1.2 each. The average market value of Hoy's equity shares during the year was $3 million per share, $3 per share. Hoy's profit after tax was 1550, right? Now this again is going to be equal to the, same as what we did there, right? So how much, how many shares were there? 2.5 million at 50 cents. 2.5 million at 50 cents. How many shares is that? How many shares is that? 5 million shares, right? 5 million shares. Then tell me, how much are they issuing? 1.2 each, 2 million equity shares. 1.2 into 2 million. What's the value? What's the value? 2 million into 1.2. 2, 400,000. Yeah. Right. 2, 400,000. Right. Now tell me, how much will you be able to purchase at the market price? What's the market price here? 3. How many shares? How many shares? 0.4 divided by 3. 800,000, right? 8, 16, 24. 800,000 shares. How many free shares are you getting in that case? How many free shares? 2 million. 800,000 is what you would have received. So 1.2 million, right? So how are you going to check your earnings per share here? Your earnings of, what's the earnings given here? 1550 divided by, here they are saying the 5 million plus the 1.2. How much is that? 5 million plus 1.2 is going to be 6.2. Tell me what's the earnings per share? Very good. 5 cents. Is that clear? Yeah, same logic, right? The extra number of shares coming in. Is that clear, guys? Be clear? How many questions now? Twenty-three questions done. Total 33 questions. Today 23 questions. Last week 10 questions. 33. How many questions to go? 17. Right. The next question. Target is preparing. Now we are moving into IAS 37. Target is preparing its financial statements for the year ended 30th September 2027. Target is facing a number of legal claims from its customers with regards to a faulty product sold. Right? The total amount being claimed is $3.5 million. Target's lawyers say that the customers have an 80% chance of being successful. According to IAS 37, what amount, if any, should be recognized in respect of the above in Target statement of finance? You recall it or not? 80% chance that customers are going to be successful. If customers are going to be successful by 80% chance, you are going to lose by 80% chance. You're going to lose, meaning there's going to be a liability, and it is probable. Therefore, it's going to be this amount. Right? If it is possible, then you have to disclose. Here you have to recognize. Right, so question in the next question part is in the next page, right? ABC has a year end of 31st December 2024. On 15th of January, on 15th of December 2024, the directors publicly announced a decision to close an operating unit and make a number of employees redundant. Some of the employees currently working in the unit will be transferred to other operating units with ABC. The estimated cost of closure. Redundancy cost 800. Termination cost, lease termination cost 200. Relocation of continuing employees to new locations. Retraining of continuing employees. What is the closure provision? What is going to be the closure provision that you're going to record? Why? Any retraining or relocating cost of existing employees is not considered. So you're considering only 800 and 200 termination costs. Okay. Any cost you are going to incur as a part of continuing employment or retraining cost, relocating cost, you don't consider under closure. Closure is going to be the redundancy cost and any cost relevant therein, right? With letting go of the employees and that contract. Okay. Right. Now this question says on 1st of October, still by IAS 37. On 1st of October 2023, explorer commenced drilling for oil in an undersea oil field. The extraction of oil causes damage to the seabed, which has a restorative cost. Ignore discounting. They are saying ignore discounting, so you don't need to consider discounting. Of 10,000 per million barrels of oil extracted. Explorer extracted 250 million barrels of oil in the year ended 30th September 20x4. Explorer is also required to dismantle the drilling equipment at the end of its 5-year license. This has an estimated cost of 30 million on 30th September 20x8. Explorer's cost of capital is 8% per annum and $1 has a present value of 68 cents in 5 years. Right. What is the total provision? Extraction plus termination. What's the total provision that you're going to do there? 10,000 per million barrels of oil. That's the first issue. How many million barrels have been extracted so far? 10,000 into 250. So how much is that? 25 million, right? 25 million. Yeah. Is it 25 million or 2.5? 250. 2.5 million, right? 2.5 million. Not 25 million, 2.5. Correct? 2.5 million, right? That's the first. Then the next one is going to be the dismantling provision. So what's going to be the dismantling provision? 30 million in 5 years time. What's going to be the conversion, the cost of capital? 0.68. The 30 million dismantling is going to be 30 million into 0.68. How much is that? How much is that? 20.4 million. Now what are they asking? They're asking the total provision to be report under financial position, right? Now in this case, the second one, now this is the first case. Second case, when you do a present value calculation, there is something else involved. What is it? Unwinding. Not time value, unwinding. What's the unwinding cost? 20.4 million into 8%, right? Into 8%. Tell me what's going to be the unwinding cost? 1.6. 1 point. That's the unwinding cost. What's going to be the total cost? 20.4 plus 1.6 is 22 million, right? 22 million, right? There'll be decimals there. Plus 2.5. How much is that? 24.5. So we have, yeah, option B. Is that clear? What areas did we cover? Now, when you take the IAS 16, what value is going to impact IAS 16 cost calculation? What's going to impact IAS 16 cost calculation? In this question, yeah. In this question, no, 128. Second, explorer dismantling cost. How much is it going to impact the cost of the asset? IAS 16, what is the cost formula? Purchase price plus directly attributable cost and any initial estimated dismantling cost. Remember, you're going to add how much? Which value are you going to add? 30.4 million or 30 million, or are you going to add 20.4 million? 30 million or 20.4 million? Quickly tell me. Quick. Got me? 30, very good. How about y'all? What do y'all think? The IAS 16, I don't expect y'all to not know IAS 16. So what happens? We start focusing on IFRS 9, big standards, and then we let go of IAS 16. Then we forget the basic. We don't know what happens. Then we do the depreciation calculation, goes wrong. Why? Because we may have not considered the dismantling cost, or we may have considered the wrong dismantling cost. Remember, present value, estimated present value of dismantling cost is what you are going to consider as a part of your cost of your asset. The non-current asset will add 20.4 million. And that 20.4 million also will be recorded as a provision liability. And provision liability will be increased every year with the unwinding of discount. Okay, this is relevant to IAS 37 as well as IAS 16, the connection there. Okay, I think in 30-day plan, I have given this point where how the dismantling provision is connected to IAS 16, right? Right. Next question. Now these are basic standard that we're going to look at. The following information is available for the property, plant, and equipment. What's the standard? IAS 16. Of FRI as of 30th September. Carrying amounts 23.4, 14.4, 20x4, and 20x3. The following items were recorded during the year ended 30th September 20x4. Depreciation charge of 2.5 million. Item of plant with a carrying amount of 3 million was sold for 1.8 million. A property was revalued upwards by 2 million. Environmental provision of 4 million relating to property, plant, equipment were capitalized during the year. What amount would be shown in FRI's statement of cash flows for purchase of property, plant, and equipment? IAS 7. How is this connected to IAS 7? Right. What do? We have to draw a T account. Now in T account, what happens? What's the balance brought forward? 14.4 million, right? What's the balance carried down? 23.4, right? Then what's the revaluation? The plant value went up by 2 million, so that's added here, right? It increases the plant value, revaluation. Depreciation, it reduces the plant value, so you record it here. Depreciation 2.5 of 1,500. Then item with a carrying amount of 3 million sold for 1.8 million. So what happens? The cost, the carrying amount of the plant goes down. The cost of the plant goes down, right? Disposal. What was the carrying amount? 3 million, 3,000, right? Environmental provision of 4 million related to property was capitalized. What happens here? The provision needs to be added as a part of your non-current asset cost. Remember that. Right. Now tell me which side is heavier. Which side is heavier? 23 plus 3, 26, 400, 27, 28, 400, 28, 900, right? 28, 900. This side is heavier. 28, 900. And anyway, they are asking the purchase. No, purchase should be coming in this side. No. Understandable, PP addition comes this side, and this is where the difference is going to be. 14.4 plus 6 is going to be 20.4. 28.9 minus 20.4, how much is that? 28.9 minus 20.4. 28.9 minus 0.4 is 28.5 minus 20. 8.5, right? 8,000. 28,900 minus 20.4, yeah? That's 28,500, and that is going to be the additions. Why? That's the balancing figure. Is that clear? Is that clear how to look at, how to add the PPE, how to draw the PPE table to arrive at the cash flow, right? 136 at 1st of October. Now these also IAS 7 cash flow. At 1st of October 20x4, BK had accrued interest payable of 13 million, right? Let's erase this part a little bit. 11 million, 12 million, right? BK had accrued interest payable of 12,000, not 12 million, 12,000. Even this will erase, right? 28,900, right? Okay. During the year ended 30th September 20x5, BK charged finance costs of 41,000 to its statement of profit or loss, including unwinding discount relating to a provision stated at its present value of 150,000. At 1st of October 20x4, the closing balance on accrued interest payable account at 30th September was 15,000. BK has a discount rate of 6%. Now what happens? What was the opening accrued interest payable? 12, right? What? Let's draw a T account here. T account. accrued interest. Right. Now, what is accrued interest? Is it an asset or liability? The liability. The brought forward value is how much? 12 million. What's the carried down balance? Carried down is 15. Right. Now, in this, what they are saying, there was interest as per financial statement. How much was that? 41, right? Interest 41,000. Including unwinding discount related to a provision stated at its present value of 150,000. Now, what happens? There is going to be an unwinding, right? This is not cash. Unwinding discount is not cash, right? So why that unwinding cost is necessary? To get the cash value, right? So interest is going to be 41,000 minus unwinding discount 150,000 into 6%, right? How much is that? 150,000 into 6% is 9,000. So what is going to be the value you take here? 41 minus 9, 32,000, right? Like 32,000. What else? Is there any other adjustment? This side is heavier. 32, 42, 44,000. 44,000. Right? So now what's the difference? 44 minus 15? 29,000, right? That's going to be the payments balancing figure. 29,000. Clear? Is that clear? I have a couple of more. 2, 3. Almost there. The next question says, Butcher had the following balances in his statement of financial position as of 30th June. How much will appear under cash flows from financing activities? We touched upon investing, we touched upon interest paid, now which is a part of operating. Now we are touching upon the financing. Right. The financing, what do you notice in financing mainly? What impacts financing activities? It's going to be the share issues, the equity changes, or it's going to be the liability changes, right? Okay. Share capital 150 becomes 170. What's the change? 20,000. Share premium 95 becomes 105. How much is that? 10,000. 10% debentures 190 becomes 170, right? So that reduces by 20, right? 30 minus 20. How much? Clear? Clear? Why? Because share capital increased by 20,000, share premium increased by 10,000. That is the share issue. Cash received from issuing shares was 30,000. But we paid back the debentures. Why? Because 190 becomes 170. So debentures go down by 20. Long-term liability goes down by 20. 30 minus 20, 10. 10 is the cash flows from financing activities. That's the whole number. But if you show it in a detailed response manner, you have to show receipts. So cash received from issue of shares of 30,000 and cash paid to repay the debentures of 10% is 1,000. So cash flow from financing activities receives an inflow of 30, outflow of 20, makes it 10,000. Clear? Right. The next one, at first of, now this is cash flow from investing activity. At 1st of January 2080, KC had property, plant and equipment with a carrying amount of 180,000, right? In the year ended 31st December 2080, KC disposed of assets with a carrying amount of 60,000 for 50,000. KC revalued a building from 75,000 to 100,000 and charged depreciation for the year of 20,000. Okay, we do the account. What's the opening balance? Carrying amount of 180,000. 180,000 is the opening amount. What's the closing amount? Carrying on the year end was 250,000. Okay, now tell me, out of this, what is added? Disposed an asset with a carrying amount of 60,000. Disposal 60,000. Then KC revalued a building from 75 to 100. By how much the value increases? 75 becomes 100. So value increases by 25,000. Why are we not considering the profit separately? Because that's a non-cash item. Okay, right. And then depreciation 20,000. Depreciation reduces the value, right? 20,000. Okay, tell me which side is heavier. Is heavier. 250 plus 80. How much is that? 250 plus 80 is 330. 330. 180 plus 25 is 205. 330 minus 205. How much is that? 330 minus 205 is going to be 125,000 addition. Right. So for additions, what do? You are going to pay, right? It's going to be an outflow. Outflow of 125,000. Okay. Outflow of 125,000. Right. But there's a catch. What's the catch? What's the catch here? Will you take it as a whole, or there is something else that will be? Okay, outflow is 125. Outflow is the purchases, right? Addition is 125. But does it make it the cash flow from investing activities? It needs to be outflow plus inflow. What is the inflow here? Disposal. There's a disposal. No? They would have received cash. No? You dispose. Though the value went down by 60, but cash received was 50,000. So there is an outflow of 125, inflow of 50,000. What is going to be net impact? 75,000. Okay, 75,000. Outflow is going to be the net impact. Is that clear? So always remember, consider the net. See, 125 is also there, right, as an option. 50 is also there as an option. Right? Had we just considered 125, we think we are right. But are we actually right? Okay. That's why MCQs see all the answers of MCQs seem to be correct. We need to remember to do it, be very particular and pay very careful attention to each of the items. Right? So we are at 150. How many questions more to go? Okay, now we are proceeding to IFRS 3, IAS 28 and interpretation, the final parts. Right? There are questions remaining. 12 questions remaining. Okay. Do you all want to wrap up at 5 sharp, or you would like to wrap up at 5 sharp? Okay. Shall we do 2 more questions? So that would make it 40 questions. So 10 questions. I leave it up to you all to do it at home. But whatever doubts you all have, you all can get to me. So I'll change the power 50 to power 40. We did attempt 40 questions, but I mean, there are some important questions we have not. 10 questions as a homework. Is that clear, guys? So let's discuss 2 more questions. Right. West has a 75% subsidiary life and is preparing its consolidated financial position as of 31st December 2086. So Life and West are a group. The carrying amount of property, plant, and equipment in the 2 companies at the date is as follows: 300 at West, 60 at Life. On 1st of January, Life had transferred. Now, this is something that we have not looked at always. I mean, we have looked at from a theory angle, but not in calculation angle, right? Which is the unrealized profit on PPE transfer, right? On 1st of January 2086, Life had transferred some property to West for 40,000. At the date of transfer, the property which had cost 42,000 had a carrying amount of 30,000 and a remaining useful life of 5 years. Right? Now here the carrying amount at the year end after transfer, how much is that? How much is going to be the carrying amount? Yeah. Now Life had a transfer some property to for 40,000. What's the remaining useful life? 40,000 divided by 5. Tell me remaining useful life. So depreciation is going to be 8,000, right? What's going to be the carrying amount? 40,000 minus 8,000. That's 32,000, right? So that is going to be the transfer value minus the depreciation that was incurred during the year, right? If it was not transferred, what's going to be the difference? If it was not transferred, what would be the difference? Carrying amount of 30,000, right? It had a carrying amount of 30,000. So what would be the depreciation now? 30,000 divided by 5. How much is that? 6. So what would be the carrying amount? 30,000 minus 6,000. How much is that? 24,000. Right. Now, what is going to be the unrealized profit? 32. Difference between 32 and 24. So, what is the difference? 8,000. Now, what happens? What's going to be the consolidated figure? 300 plus 60 minus the unrealized profit, right, of 80, right? 80. What's the answer? 360 minus 80 is, yeah, sorry, 8. $360 minus 8, how much is that? 350. Remember, guys, unrealized profit for non-current asset transfer is always going to be the difference between carrying amount after the transfer and assuming carrying amount. If the transfer did not happen, what does it remind you of? What do you all recall? Reminds you of something. The carrying amount, had the transfer not happened, had the transfer happened. But this should remind you of something else also. Depreciation, you can consider cost depreciation, had the transfer happened, had the transfer did not happen. But transfer to be replaced by something else. IAS 36, impairment reversal. Remember, how do you see the difference between impairment reversal? What can you reverse? You can't reverse the entire amount. You can reverse only the amount between the carrying amount after the impairment and assuming there was no impairment happening, the carrying amount there, you consider different, then that difference is what you are going to reverse. Now here, what you are going to eliminate? You take the carrying amount considering the transfer, right? How much was the carrying amount after transfer to the subsidiary? And had the transfer not happened, what would be the carrying amount? The difference is what will be the unrealized profit that you will have to eliminate from your consolidated non-current statement of financial position. Is that clear? Is that clear, guys? $10,000. Yeah. And do that also. 10,000 divided by, yeah, 10,000 divided by 5 is going to give you, anyway, it's going to give you 2,000. So 8 is going to be the outstanding. 10 minus 2. It would work. But this is a long, always I would prefer you all using longer route rather than a shortcut. Yes, if you all have become experts in longer route, then you all can consider shortcuts there. But test on the longer route. If what you're doing as shortcut is going to help get the answer that you get through longer route or not. If you get the answer in multiple places, then after multiple questions, you can decide, okay, I can use that shortcut in the exam. Okay, but practice with longer route. That's what my idea is. But shortcut, you all can have it prepared for the exams. But always in exams, it's better. So just test with a longer route if it is right or not. Okay, right. The final question for the day. Harry acquired an 80% holding in Style on 1st of April 20x6. Means the year end 31st December, a mid-year acquisition. From 1st of April 20x6 to 31st December 20x6, Style sold goods to Harry for 4.3 million at a markup of 10%. Harry's inventory at 31st December 20x6 included $2.2 million of such inventory. 2.2 million remains. The statement of profit and loss for each entity for the year to 31st December showed the following in respect of cost of sales. What is the cost of sales figure to be shown in the consolidated statement of profit or loss? So what do? You take H cost of sales plus S cost of sales into how many months? April, May, June, July, August, September, October, November, December, into 9 divided by 12 minus the transaction that took place, intra-group sale plus the PUP. Okay, that's what you are going to do. What is H? 14.7 plus what is going to be the S? 11.6 into 9 divided by 12. How much is that? Quickly tell me. 11.6 into 9 divided by 12, guys, quickly. 8.7. What's the intra-group sales? 4.3. What's a PUP? Unrealized profit? How do you look at that? 4.3, right? Out of which, wait, 4.3 was the sale, right? Harry, for 4.3 at a markup of 10%, right? So what would have been 4.3 is your sales, right? Revenue. 4.3. GP, how much? Markup of 10%. How much is the GP going to be? 4.3 into, when you are considering the markup, the cost is considered as 100. So revenue becomes 110, right? So to arrive at GP, you're going to get 10 over 110. Okay, so how much is that? Hmm? 4.3 into 10 divided by 110. Can be 0.3909. Okay, 0.39, right? 390, let's call it 0.390, 0.4, right? So what should be the cost in that case? What would the cost be? 4.3 divided by 110 into how much? 100, right? 3.9, right? Now out of this, what they're saying, what's the unrealized profit component? It's 2.2 million only, right? Now 2.2 million is the goods value of unsold goods, right? So that's what you're going to consider here. 2.2 into 10 divided by 110. What is going to be the profit for this? 2 million, right? 2 million. 2 million. Can't be 2 million. 2.2 is a 2.2 million into 10 over 110. 0 point. Right. So what is going to be deducted from here? 0.2. So what's going to be the figure? 14.7 plus 8.7 minus 4.3 plus 0.2. How much is that? 4 point total. 14.7 plus 8.7 minus 4.3 plus 0.2. 19 point. Clear? That's the answer. How many questions are we done with? We are done with 40 questions, right? How many questions? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 questions are exactly there. So I want you all to just take a screenshot of these question numbers. This is the questions in Kaplan revision kit 24-25, the latest one, right? So these questions are going to be your homework and you will have to attempt these questions at home. If there are doubts, since we're not going to discuss those anymore, any doubts, get back to me. Mock papers, guys, I'll be sharing on the group. I hope all 3 of you are there on the group. I've taken a picture of your contact numbers as well. I have to save that. Let me check that once again. Once I have the contact here, Right. Okay. All right. I have all 3 contact numbers. I'll check if you all are there on the group, and I'll share the mock on the group. Please make sure you all attempt the mock. Very important. If you all share your mocks with me, I can get back to you all with a tailored feedback as to what are the areas you all need to focus on. If I get that to you all will have enough time to focus on that a little more than what you all will be focusing on other areas. So 30-day planner, please follow that as it is 7 days gone for the 30-day planner. I'm assuming, now let's just quickly have a look at day 8. So when you take the 30-day planner, today you should be covering IFRS 16, right? Financial instruments should have been covered by now. IFRS 16 is what you're covering today. IAS 12 tomorrow. So please make sure you all stick to the 30-day plan I've shared with you all. Once you all stick to it, definitely you all are in a position to earn more than 70 marks. That I can assure if you all follow that. Share the mock. I'll share the mock with you all. Answer that and share it to me as soon as possible. I'll get back to you all with tailored feedback. What are the areas you all need to focus on? Focus on that, and I'm sure you all will be able to get through with great marks. All right. So next week I will be starting the past papers, and we are intending to cover pre-mock as well. So again, past paper will be discussing more than doing the paper in the class. It's discussion that's going to happen. So please make sure whatever past papers you all can attempt at December pre. You all will be doing. That's why I'm discussing that on first. I've given the date that I'll be discussing the pre-mock. 1st of December is when I'll be discussing that. So by that time, I'm expecting you all to have completed that. When have I given you all the pre-mock attempting in your 30-day planner? 30-day planner, you all are going to attempt the pre-mock on 24th day. 24th day is going to be around 27th of November. So I will be giving you all enough time after 27th of November also. So get the pre-mock done, and we'll be discussing the pre-mock on the 1st of December. Therefore, please make sure you all are attempting as many questions as possible. Next time we meet, we will be on the 14th day, right? So we'll be doing a paper. So anyway, when we meet again, you all are expected to get done with most of the papers. All right. So all the very best, guys. Keep up the preparation. Keep up doing the great work. Keep up. Don't lose touch from afar. Keep up with the 30-day planner. Attempt as many questions as possible. Take the Kaplan dosage that I've given you all, 60 mock MCQ questions per day. Do all of that, and I'm sure you all can get through with greater marks. If you all have any questions, any doubts at any point, you all can always reach out to me. I'm very active during this month because I want all of you to get through. All the best. I'll see you all on the next week.